IVM.
Financial inclusion. What does that even mean? When we talk about things like microfinance, are we talking about anything beyond credit and loans? Malavika Raghavan joins Manasa Venkataraman and me for a wide-ranging discussion on this episode of the Pragati Podcast. Welcome to the Pragati Podcast, a weekly talk show on public policy, economics, and international relations. I'm your host, Pavan Srinath. Joining me as a co-host for this episode is Manasa Venkataraman, my colleague at the Takshashila Institution and a previous guest on the Pragati Podcast. Our guest today is Malavika Raghavan, who heads the Future of Finance project at Dvara Research. She's a lawyer by training and was a 2018 Chevening Financial Services Fellow at King's College London. Malavika was in Bangalore to speak at the Carnegie Tech Summit 2018, and we managed to get her into studio then. We talked to her on this episode about microfinance and its troubles from a decade ago. We talked to her about what is happening on the financial inclusion front in India with the rise of smartphones, Aadhaar, and a rapidly developing financial services ecosystem. Before we get started, Kannada barutta? ಸ್ವಲ್ಪ ಅಡ್ಜಸ್ಟ್ ಮಾಡ್ಕೊಳ್ಳೋಕ್ಕಾಗತ್ತಾ? The Thale-Harate Kannada Podcast is the latest show on IVM. My friends Surya Prakash, Ganesh Chakravarti and I have launched a weekly Kannada podcast that bridges the Kannada and English worlds. This week on episode 3, we speak to Sandesh Anand about hacking and cybersecurity. The link is in the description. Check it out and ಬನ್ನಿ ಕನ್ನಡದಲ್ಲೂ ಹರಟೆ ಹೊಡೆಯೋಣ. We'll be back with Malavika Raghavan and Manasa Venkataraman after this short break.
Hello, everybody. Welcome to another great week on IVM Podcast. If you're not following us on social media, please make sure that you do. We're IVM Podcast on Facebook, Twitter, and Instagram. Like I mentioned last week, on Instagram, we have a bunch of interesting content coming up. Make sure that you check it out. You'll really enjoy that stuff. On the 100th episode of The Seen and the Unseen, Amit Verma's guest is economist Shruti Rajgopalan. They're going to answer some listener questions and look back at the year and look ahead at the next year. On Geek Fruit, Tejas and Dinkar talk about how the new animated Spider-Man movie Into the Spider-Verse might just have given us the best version of the character yet. On Paisa Vaisa, Swapnil Bhaskar, co-founder of Goalwise, talks to Anupam about setting financial goals and how you can achieve them. On Know Your Kanun, Amber helps us understand the rights and powers of traffic officials and how they function in India. Last week, IVM Lights released its 100th episode. Listen to this celebratory episode as Janam, Abbas and Surbi deep dive into their top picks from the year 2018. Once again, thank you everyone for sending in emails and voice notes talking about their favorite moments from the show. We really appreciate that. And with that, let's continue with your show.
Welcome back. Hi Malavika, welcome to the Pragati Podcast.
Thank you. I'm glad to be here.
And hi Manasa, welcome back.
Thank you. I'm glad to be here too.
Malavika, we really want to know how to think about finance and access to finance in the country. We're a country with very few income taxpayers, very few bank account holders. Well, that might have changed given Jan Dhan, I don't know.
Yeah.
But can you tell us a little bit about how to even start thinking about India and Indians when it comes to finance?
Yeah, sure. I'm happy to paint just a broad landscape. The good thing is there's a large community having a conversation about this. But just to give you some kind of headline figures that I generally find effective in terms of setting context. So we know the one thing is if you take the typical sort of average Indian person, first there's a big rural-urban divide, right? About 68% of us in the last census actually live rurally. And what's interesting is that in terms of just money, about 77% of those rural people are in a household that makes about 10,000 rupees a month. And in urban India, that's still 45% of people are making something like 10,000 rupees a month. But so basically, you're talking about people who have not very much in terms of on which they're balancing their households, right, on a month-to-month basis. But they are using finance quite a lot. So there's like many figures around access to finance. But one thing that sticks in my mind is there's the World Bank Findex report. And they talk about the borrowing that someone did in the last year from a formal institution in India. And the number is something like 6%. So, and the number of people who've taken loans is quite high. I'm not sure. I think it's closer to 80% or something. So it's interesting because clearly there is a reliance on debt, but a lot of people in the country who are not kind of in the first quintile generally rely on friends and family, basically, and your informal money lender in order to access some of these products. So they don't actually go into bank and get like a proper loan with clear interest rate or an insurance product. It's a lot of it is what we think of as kind of social insurance. Everybody waits for an emergency and then you rely on kind of friends and family, or you take out a totally unsuitable loan at quite a high rate of interest. So that's kind of, I'd say, broadly where a significant chunk of the country is at the moment.
And significant chunk of the country also does not have the luxury of a salary, right? So when we're talking about 10,000 rupees a month, this is not steady across a month. We're talking about an aggregate sum in a year. The payment or the receipt of money can be lumpy. And a lot of time people have to make upfront investments, right? Be it in agriculture or elsewhere. So on those counts, this informal money lending network that you're talking about is sometimes the person who's selling you seeds, or the person with the APMC who's a trader who gives you some credit. So it's all of that. Plus our horrible healthcare system and everything else, which requires high sudden need for money. Right?
You actually hit the nail on the head, because a lot of the workforce is kind of seasonally employed from what we know. It's hard to talk about the workforce without clear jobs numbers in India, but we know that, they have this annual employment survey, which is a Government of India run. I think the last was 2016. And there they say about close to 42% of people basically work seasonally.
Okay.
So, these figures that say 10,000, most of that's very patchy. And especially when you look on the agricultural side, there are clear, like around harvest season, there are clear peaks and troughs. And you need investment at the point when you're sowing and harvest, and certain seasons where you're not actually doing agricultural activity. So that's a very big point in terms of why finance is important, because we think of it in two ways, right? Like access to formal finance, it helps in intertemporal smoothing, which is like taking your risk from one part of your year's spread, moving it. It's basically risk management. And it's just easing those kind of liquidity constraints as well. And then the other one is kind of, once you've passed that risk from one side to another, it's also how can you pass the risk between players. So it's the classic case of you'd never buy a house upfront or a car. It's much more efficient to actually get a loan for it, because then slowly title passes as you make payments. So at the end of 20 years, you're not holding all of the risk of that asset on your household balance sheet from day one. You're actually sharing it with an institutional player who is much better prepared. So I don't know what the last crisis said about that analogy.
but the idea is that hopefully if the lending mechanism is responsible and accessible, you can have access to a house well before you can actually accumulate all the money to pay for the thing up front. Right? So you can have a quality of living improvement just by having that access to finance. And I remember, I think my economics professor talking about insurance and its function of just smoothing risk. And the first time I heard that, it blew my mind. We think about insurance in a very different way, very instinctually. But all credit mechanisms work in similar manners. Right? Whether you're buying health insurance or whether you're getting a loan in order to invest for the crop season.
And actually, this is a really important point. And the thing is, if you think broadly in terms of 4 or 5 categories of products, it should be a mix of products, but leave that to the side. But if you think of something like a payment, a credit, an insurance, and then say something like an investment product or a pension, there are different scenarios when you should be using different products appropriately and suitably. And this, what you're talking about, is one of the fundamental problems, I think, in the country. It ties to a lot of things which we are seeing right now, the farmer credit crisis, a lot of debt traps that people get stuck in. Because one thing you normally see in the data is there are spikes if you are plotting a household balance sheet around specific types of shocks or events. And then if you look into it, you're like, what is the shock or event? Of course, you have natural disasters, but a lot of the time it's things like school fees and emergency health loans. So in June of every year, you'll see a sudden spike in loans, and then if you look at another spike, and you'll see suddenly somebody fell ill and went to the hospital. Now, it would be much more efficient to actually be paying a small premium amount and be covered for that shock. But it's that classic, behavioral bias, and also just a fundamental, I think, liquidity constraint. There are a whole bunch of reasons we can get into about why people are not getting insurance in India. whereas that would be the most efficient solution in some of these situations, rather than going and taking, 50% loan, which then indebts you for God knows how long. But it's a classic. I mean, that's the number one. I think we were talking about this household finance report. It talks about the largest kind of reasons why people are taking loans at kind of unsuitable loans as well. And definitely emergency loans for health and stuff are one of those shocks. And in that case, it should just be insurance,
So could you tell us a little more about that?
Mm-hmm.
So if I understood you right, it meant that we are taking loans, which is one kind of a financial instrument, because we are not accessing other types of financial instruments.
Exactly.
So could you spend a little more time on the 4 broad categories that you just spoke about?
Yeah, I mean, the reason that I mentioned those is sometimes it just helps us to think about, disaggregate some of these issues. But it just ties to this whole idea of, on the one hand, there's functional regulation, which we can get into later maybe. But you're just looking at the function of a financial product, and then you regulate accordingly, right? But from a consumer perspective, what does this mean? It means that essentially people they don't shop for a loan, or they don't shop for insurance, or they basically want to get something done, and they're looking for a financial product that helps them get them. So the education is a great example. So in a perfect world, say you're in a village somewhere in India, one of the 70% of Indians, 68, and you have a 5-year-old and you're like, I want them to go to university. Now, you should really have 2 options. You should be able to start a savings product now, if the chances are that your child is only going to go to a polytechnic and then maybe even come back and work in agriculture or go to the nearest university. And if those fees are very high and the paybacks don't really make sense, to take out a large educational loan, which is going to have a significant interest and a very short repayment period and put stress on the family, you should have somebody to speak to who says, just start a small kind of savings product now. And both of those will get you to the same end objective, which is, as a household, your goal is, I want my kid to go to university. This is like one of the big goals of every Indian household. I think that's one good thing across kind of quintiles. But for some reason, we're not, most people get to that point, and then we tend to, unfortunately, I think we see more of a push of credit. And I think this might be the experience in our lives as well. To be honest, I'm saying all this, but if I look at my own portfolio, it's a terrible portfolio. I'm totally misinvested.
I'm just checking myself as you speak, saying, oh, I shouldn't have done this. Oh, I shouldn't have kept a loan as my option if I want to sort of go abroad to study at some point later. So this is great education for me.
Yeah.
And this to me is fascinating also because often the discourse is about, the India's poor do X, Y, Z, whereas those of us who are better off are not terribly smarter, right? If I'm not mistaken, health insurance in India is just about 25,000 crores, private health insurance. There are enough well-off Indians, and most of that 25,000 crores will come from sort of MNCs and others, where your employer sort of mandates insurance and pays for most of it, right?
Yeah.
So even Indians who are well off do not want to buy basic health insurance.
Yeah.
At the same time, there are these LIC products for life insurance, which are not quite insurance. They are something, right? There is some cover plus some benefit. Mm-hmm. And I remember having this weird conversation with my insurance agent who was talking about, oh, sir, but this is only cover. You will not get a return. Like, no, the point is, what if something happens to me?
Yeah.
And then I want enough money for that.
Right. No, definitely. Because I think with insurance is really interesting because, this is something that I'm trying to learn more about myself, right? Because it's the classic kind of incentive misalignment problem, I feel like, across the industry. This is just my personal opinion. Because you have all of these agents who are just pushing products, and we're not really quite sure what you want from the product. Do you want insurance or do you want an investment return? And those two things are different. But Monica Hallan, the journalist, writes quite a lot about this. There's some interesting papers that she's written with, I think, Susan Thomas and Renu Kasani, these two economists. And they're basically talking about mis-selling, basically large-scale mis-selling of insurance products in India. And this really goes to what I kind of come back to the regulatory problem and solution at all points of time. We don't really have a very strong kind of conduct regulation, analysis of suitability, telling your customer, actually this may be good for you, this may not be good for you. Finance in some sense It's not an off-the-shelf product. We think of it right now in this goods and services kind of way, where we're like, oh, you go in, you like those shoes, you buy those shoes, or you like that, I don't know, bottle or detergent or something. And there's terms and conditions on the back and you use it. But finance is not really the same. It's something a little bit more involved. So legally we call it caveat emptor, which is just buyer beware for all your off-the-shelf sale of goods. But really we are trying to shift this at like Dvara Research to a kind of more caveat venditor, or like the buyer takes responsibility,
The seller takes
the seller takes, you are right. So in that sense, it also ties interestingly to some of the data conversations that I know Manasa has been part of, because this whole idea of fiduciary responsibility, being held to a higher standard of care when you're doing something or a complex product or which the buyer can't actually beware, because it's like the idea is like a car. You don't need to know how the internal kind of everything in the car works, the engine and this and that. You just need to know how to drive a car. And it's up to the seller to say, everything is fine. And then if it's not fine, then you have a kind of situation where, which is the company that got caught for their emissions? Volkswagen, yeah.
Oh, yeah.
And that was entirely not, the consumer was not involved. There is a regulatory fix. They gamed the system and they were taken to task because I don't need to, as a consumer, be thinking about how emissions testing should evolve,
And we are coming to a condition where the Volkswagen Beetle might die in 2019 because Volkswagen is paying the price for doing this, large-scale fraud at a global level.
Yeah.
And of course, there are other concerns that they're not paying enough.
Yeah.
But so you're completely right. I mean, so in finance, how do we start thinking about this, right?
Yeah.
So let me maybe come back to this finance and loan part, and then we'll go to insurance and more.
Yeah.
From hazily what I can remember, there was a microfinance boom in the country, right, as of a decade ago. And in this boom, there was talk about how there are many people who don't have access to banking who are being included because small amounts of loans are given. And there are new mechanisms to get people to pay these loans back. Because the principal problem was, how do you get someone to pay this loan back? And there's a cost involved to that, right? Yeah. So I remember looking at numbers like 2% interest per month, 3% interest per month for this microfinance. And then I know that, okay, with SKS Finance and with some things, this microfinance bubble burst. Could you tell us some more about that and what's happened since? How do we look at this microfinance? I mean, it feels like a sector and a very technical thing, but could you give us some context?
Sure. So this is basically like summarize microfinance in 5 minutes.
Yes.
I'm not even an expert. But I can kind of tell you, to be honest, I'm also still learning about all of this, but I can tell you bird's eye view of how I think the last, more like 20, 25 years panned out. So this whole thing started obviously with Mohammed Yunus, Grameen Bank, and this idea that you can give people income generating or entrepreneurial loans in some sense to help them, graduate out of poverty. So you're not talking about absolute poor, but you're talking about the working poor. And his whole, analogy of, I think he was a professor and there was some kind of a calamity. So he went out and literally gave 50 women some loans and they paid it back, and that's how this whole idea started.
Wow.
And it's interesting because I've heard him speak a couple of times and he talks about recasting traditional economics we're always talking about human beings being very selfish actors who are like profit maximizing and so on. And he's saying we're not accounting for something which is like kind of a selfless side of things. So it's obviously got a great narrative. Nice to get involved with that narrative. On the ground, the way things are in India, it's like everything in the end, there's shades of gray, So they are. So microfinance should technically be finance. Microcredit should be one part of finance. But unfortunately, as even hearing you talk about it, that credit has dominated microfinance, which in itself I think is a bit lopsided.
Yeah, microfinance means loans.
Yeah.
Honestly, I mean, insurance is insurance,
but
not finance.
Yeah.
But I'm telling you, I mean, even for me, when I think microfinance, I think loans.
Yeah. Because I think it's kind of, it does reflect how the industry has developed in India. So one thing is that microfinance was already working on top of something called the self-help group movement. And this was also government supported. And if you look at the states where microfinance has really flourished, they actually are also the states where SHGs were quite active before. So in a sense, it's like it was able to use some of the capacity and other stuff that had been built up on these women who are already taking control of their lives in some ways. And self-help groups are just like sort of groups of women who come together to get involved with a financial product, basically. And they may also in the back end be doing some kind of industry, a cottage industry, or doing something together. So at the simplest, what is a microfinance loan? What you think of as a loan. So the big innovation that Eunice did and that we are all talking about actually, and this industry thinks about, is so when you're looking at very poor people, they don't have a lot of assets, right? And loans traditionally are tied to a secured loan, a collateral, right? So and therefore the traditional logic was always, therefore these people don't have collateral, so we can't give them a loan, and then it's a chicken and egg situation. So what the joint liability group loan does, it's a JLG, is it sets up a group of people and it uses some kind of like social capital and social pressure in order to reinforce that payment. So it's an unsecured loan, but because 5 people have joint liability to that loan, and you do joint liability, like group training and everything, you get people into this loan together. There are some basic rules. I can talk about what I know from the Dvara KGFS example, which is the kind of our NBFC, which is called Kshetriya Gramin Financial Services, and I mean in the ecosystem. I work on the policy research side. So we're not exactly connected, but what you do is you ensure certain things like family members are not part of the same group, for instance. So it's actually a group in a village. And now the thing, what happens is because you have this kind of almost cross guarantee mechanism, if someone is falling short, other people make it up, or people are able to act as a check. So the consequence of this is you see very low defaults. You see something like 99% repayment rates.
Wow.
Yeah. For non-collateralized.
Incentive alignment.
Yeah. And there's a lot of work around like network theory and what's going on. Interestingly, microfinance predominantly to women. And there is a large empowerment narrative here, right? Like that you get women borrowers. But the other thing of it is also women tend to stay in villages. Women tend to have social pressure. So that's something I'm also discovering, right? So it's an interesting... the incentives are aligned for, I think, positive outcomes somewhere, because you're getting women hopefully more financially empowered. But then in some sense, you're also using some of our existing dynamics around women tend to be more, not migrate and so on.
So in that sense, if you're actually a part of an SHG in a village, your own mobility outside that village can be hampered, right? Because you're a part of this tight network, you've taken a loan together, now you're building a business. But even if there is an opportunity, say far away in Bangalore or Chennai or somewhere else, it might be more difficult for you to access that.
You're actually talking about something that I've been kind of worrying about the last few weeks myself. So I think on that point of kind of women borrowers in microfinance, something we've been thinking about recently is also what are the gender dynamics of finance and technology as a whole, right? So I think I was making this plug around Dia George from IRMA, which is Institute of Rural Management in Anand. So she worked with us for a couple months, and we've just started a 3-part series on kind of gender finance and technology. And one interesting thing is when you look at mainstream finance, women are quite excluded, right? And there are some clear barriers, whether that's social barriers around like just access to literacy and so on, but also lack of ownership of property because of the way that our kind of legal and cultural norms work around property ownership. And just these kinds of issues around perception as well, that can often block availability of finance for women. And also pre-existing data, for instance. If you've not been a woman borrower until 20, 30 years ago, women didn't have an income stream. So it's fair in a credit assessment to say, why would I give a loan to this person? Right. So in some sense, microfinance is trying to invert that. But in doing so, do you actually further entrench these? Because you're using social capital, are you further entrenching some social norms? And I think the question is then not to stop doing it, but how can you ensure that your conduct, your collection practices and all of these things don't reinforce those norms? And very much hope that a lot of these companies do, which actually brings us back to the larger question of how did all this pan out in India? And we saw quite a meteoric growth of microfinance companies. This was kind of, I would say, around the 90s and 2000s. And it was interesting because it's not like the Grameen model was followed everywhere, right? Grameen was also one of the big innovations, is that the people who took the loans were also depositors, and they also owned the institution in some sense. So it all kind of, the borrowers are the institution. There were lots of interesting little incentive alignment things that happened. We don't do that so much in India. It's generally something called a non-bank financial company, an NBFC, which gets this license to do this kind of lending activity. And they generally can't, they're different from the bank in many ways, including the fact that they don't have capital regulation because they have limited amount of deposits and things like that. So you had this NBFC market which was growing. Different people had very different strategies. Certain people, again, I'm not trying to plug, but KGFS, the Kshetriya Grameen Financial Services, which kind of Nachiket Moore and Bindu Anant have written about and kind of worked on. That idea was really, how can you get a suitable mix of financial products irrespective of your income group? Okay. And there's a book that Bindu had edited and has lots of submissions from various people that talks about financial engineering for low-income households. So the idea for this particular NBFC is always, how can we get that mix going? So if you go to a branch, you have someone who comes in, they give you your income and expenditure statement through a conversation. And then you have a kind of tool that runs a wealth management plan. And then the loan officer, or the person in there, the wealth management officer actually will then say, given your household goals, it's goal-based investing, basically. You should do X, Y, and Z. However, this is the perfect world. And obviously, they were not scaling as quickly as some of the other more aggressive players in the market. So you did have, I always worried about naming names, but unfortunately, I think the one we do know about SKS and Spandana, on some of these names, especially in Andhra Pradesh. So this was really the turning point for microfinance, is there was a heavy giving out, there was a chasing of targets. So we know, anecdotally, I know that many officers were just given targets, like give these loans out. And there was a big, actually, debate at the Clinton Global Initiative, I remember. This must have been sometime around 2009 or 10. Where you had Vikram Akula, who was, I think, the founder of SKS, facing off with Mohammed Yunus. And Akula was saying, we should totally be able to tap the capital markets to raise finance for microfinance. We should be aggressive. This whole new model. And Mohammed Yunus was just not having it. It was all very, this big blast off that happened. You should look it up. It's quite fun. And actually, it was also the timing was, in hindsight, quite prescient, because a few weeks later there was this spate of borrower suicides in microfinance in Andhra Pradesh, and suddenly you had this massive crisis. The interesting thing is, once it's based on social norms, the domino effect is incredible, right? Because if one community is facing this crisis and they're we're not paying back, then it's really dependent on the group, the strength of the group, the networks, how it works. So basically there was a large scale, what you would call a default, I would suppose.
So from 99% repayment, it was just a switch off to something far lower.
Kind of overnight, yeah.
And fueled by real crisis and real problems in payment.
Yeah, I mean, this was a real moment for the microfinance industry. I mean, I wasn't, around then, but I do know that watching it from afar. So I was still very interested in this space, and I was reading all of the reportage. This thing that is supposed to be so wonderful, and suddenly you have these suicides, that's kind of the worst thing you can do when you're involved with a vulnerable population, is kind of further exacerbate their vulnerability, right? And on the face of it, there are lots of narratives now, I know, again, not having been around then in this sector, that there were lots of political motivations. So if you look deeper into it, you find that a lot of people in certain of these constituencies were actually political leaders. There were definitely some dynamics between some of the institutions, some of the borrowers, what we were talking about in terms of class dynamics and political dynamics at the village level. And what interestingly happened is the state then brought overnight a kind of a law that just basically shut down the industry, state of Andhra Pradesh. Okay. And it was very, I think it was a trying time across the country. And then we had something called the Malimat Committee report. A committee was formed, they went into it. They actually have a new, a full legislation. And interestingly, I mean, to go back to the beginning of the conversation, you were saying 2-3% loans, small ticket. Actually microfinance is very, very high. They actually capped the amount that you could lend the loan at 26%. They capped that. Yeah. So now it's capped for loans up to 50,000, I think. It's capped at 26%. And that, like, I would never, like, think that's a good deal, right?
That's horrific.
But, I mean...
So wait, 26% per annum?
On that loan, yeah.
Okay, so 26... Yeah. So how high were they going before that?
Yeah, you could have 20, 30, 35. You had, like, various, yeah. I'm double checking, but definitely 26. That's the rate cap. Okay. And see, once you look into the unit economics of all this, it does, somewhere it starts making sense. Because why microfinance is very different from your traditional brick and mortar is that all those costs are taken on by the company. So you often will have a collection or a loan officer going to the village on its doorstep banking, right? You literally have a person who takes their bicycle or walks straight into the village, goes to your house at the appointed time, week on week, month on month to make the collection. All of this group training that we were talking about, you then still need some kind of outpost branch where they can all collect. You need an entire cash management system. And mind you, the cost of funds for a microfinance company is much higher than a bank because they're a microfinance company. So even getting a bank to lend to MFIs is hard enough, even with priority sector and all this, which is why, totally on that cost of funds point, one big innovation we've seen also from this Northern Arc, if you've heard of them, they used to be called IFMR Capital. They were from our kind of group of companies. And this is not just a plug. It's one of the reasons I came to work for them, I think, because they had this kind of systemic view of change. And one thing they were saying is that, first of all, we're not originating nice enough products, but you're also not then transmitting that risk to someone who can hold it and aggregating it, right? And really one effective way to do that is through bond markets and capital markets. So they actually set up a company which opened the market, and now you have few other arrangers who do this. Basically, they will take loans from various companies, affordable housing, microfinance, anything that serves a low-income group, pool it, and then offer a bond on that to an investor who will take that bond and then take the risk of these underlying loans. And the reason why they did this is, one of the other reasons is a funding constraint. You have to go to the capital markets. Because,
I was just going to ask. Yeah. So that would actually be a more enduring sort of solution, is to open up to the capital markets.
Yeah.
In the absence of that, the logic of behind capping the interest at 26%, did it all have to just do with the costs that the MFI would otherwise incur?
Yeah, see, it really varies because they're very... Sorry, you were going to say something?
And doesn't that exacerbate the vulnerabilities of the beneficiaries, say so?
Yeah. Mind you, a lot of these people are living in a world of bad choices, right? If you think 26% is high, what they're getting with their informal lenders is like much higher. I'm sure. And that's why the market even exists in some sense. I still think it's easy for me to kind of sit outside of an institution like that and say it does feel high to me. And interestingly, after the 26% came in, everybody kind of fell in line. So clearly there is some margin in there.
That's an interesting perspective.
There is clearly some margin in there. But unfortunately, I think their cost of funds is pretty high and their servicing costs are really high. So they would never like 2-3%, 8%. Because in a bank, what are they doing? They're just sitting on the money and they're doing their bank management with a lot of legacy systems. That's it. Whereas here, your whole model is working a lot harder to get that same. And sometimes there's actually a paper that a couple of my colleagues wrote like back then about the cost of credit. What does it cost a PSB to give credit, a banking correspondent, a private sector? And it's very high. Like even at the Carnegie Tech Summit yesterday, Anubrata Biswas had some numbers. I don't know if
I wasn't there for that.
Something around like 4,000 rupees is the cost in order to just give a loan, the same loan. We had a different number for 10,000, kind of. So even just giving that loan, the percentage of cost is high. So anyway, there are many rationale for why it's 26%, but this all happened, mind you, after the crisis.
Right.
And also then the question then became is like the sheen of the industry kind of wore off a little bit. It's back to kind of business now. We do have some concerns on over-indebtedness in microfinance, actually. So another thing that two ex-colleagues of mine, Vaishnavi and Rachit, did is they ran this study of 400 households in a place called Krishnagiri in the district. And they just took like kind of month-on-month household balance sheets, right? And tried to look at how are people managing their finances. And actually the findings were pretty worrying because a lot of them were cycling like multiple loans.
Okay.
So there's no defaults really, but I think one of the concerns that I personally have is in the absence of a default, like, are you still over indebted?
So this is sort of the Indian rural version of the American credit card crisis, right?
Yeah.
Okay, you can't pay back this. And credit card loans are also similar. We're talking similar numbers, right?
Yeah.
26% or maybe even higher.
Higher, actually, yeah.
Higher. And that's...
APRs are very, very high.
That's America's problem. Let them figure it out.
Yeah.
But this idea that you keep taking on loans...
Yeah.
And you have a domino effect and you don't know when that set of dominoes will come crashing down.
It's interesting.
And what shock from demonetization to other things will do to this, right?
Yeah. And that is very interesting because around demonetization, funnily in Tamil Nadu at least, there wasn't actually a very big drop in defaults, like, increase in defaults, I mean. And so then the question becomes like, how are these people doing this, right? I mean, my concern is, were people cutting consumption to like pay back some of the loans? But mind you, like, it's not that the microfinance loans are driving this. When we say people are cycling loans, they are also cycling informal loans. So one thing we're saying is it's not that with the entry of formal credit, it's driving out informal credit. The funny thing is households are using a mix they have a portfolio of formal and informal credit.
Okay. So the way we think about formal credit, microfinance and the traditional lending.
This thesis that, people be like, there's a bank now, boom, I'm never going to...
It's not a sudden change in behavior. It's just...
No, and people are definitely some kind of optimization. And I think a lot of this is driven by that thing we were talking about, like focus on credit, right? Like something happens, you need a loan, and informal money lenders, they have some design features like that. They live in the village, they access 24/7, you'll have like a family relationship with them. So you just turn up middle of the night, your mother or your child is ill, you need to rush to hospital or do something. Who are you going to go to, right? And then suddenly you've done that immediate thing with the bounded rationality and all that. And then, so it's a complex problem. A lot of this is also driven by how our society is set up. But ideally, if we had a decent insurance product, you wouldn't be put into the situation in the first place. So I think the industry really, and now the real big pushes, and we were actually, my colleagues and I were at this Inclusive Finance Summit. They actually did a panel on suitability, operationalizing suitability. How can we build up a model of how a loan officer can quickly check if something is suitable? So even if it's legal, it's not a missale, it can still be unsuitable. So like, what can you ask that household about their existing, liabilities and existing assets before you give that loan, and then see it's truly suitable? And it will require a lot of will, right? Because ultimately you're telling companies, if you get that unsuitable kind of pop-up, you're not going to lend.
We'll be back with Malavika Raghavan and Manasa Venkataraman after this short break.
Family businesses get a bad rap. At one time, they were looked down on for getting rich, for being too ambitious. Today, they're still looked down on, but for not being ambitious enough. Not agile enough, not modern enough, too traditional in their mindset. The biggest brands and business houses in the country started out as humble family businesses. It's the way India has done business. Join Sonu Bhasin in conversation with stalwarts of Indian family businesses on the Inheritors podcast series by Bloomberg Quint. Discuss the highs and lows, the needs and pressure points of building a business legacy that spans generation.
Welcome back. So Malavika, with this, we had this bubble that burst about a decade ago. And then a whole host of regulations came in. The cap was one part of it. And then these microfinance institutions also got their own set of laws, not just at the Andhra Pradesh level, but at the national level as well. Right?
Yeah.
But since then, we've also seen technology sort of seep into various parts of the economy in India, right, over the last 10 years. There have been more smartphones. Now you can get more data. Aadhaar came up. So how do you see the growth of, one, the microfinance industry and financial inclusion in this last decade with technology playing a bigger role?
I mean, that's very interesting because inclusion and access to finance needs to be wider than just microfinance, right? So I think access generally across the board, if you look at any quintile of the Indian population, you find that we are doing things differently from other parts of the world. Irrespective of whether you're rich or poor, you're still invested in assets that don't work for you, financial instruments that don't work for you. Everyone's still buying gold and putting it in real estate, which is not great if you also have bubbles building up. And so actually the question is whether people are actually creating a surplus in their life as they go, or actually are they running down their own wealth. And that same household finance report we were talking about, it shows that this is true irrespective of how rich or poor you are. So there's one thing.
So we like gold and we like real estate.
And maybe we don't understand or / trust financial markets. I don't know if things like demonetization help or like make this better or worse. Yeah. But clearly there's something about like there's a one-arm distance, right? And this is like, it's bad for the household because it's not an efficient way of managing your risk, like buying that house. But it's also not great for the system because you need financial depth. It's a symbiotic relationship, right? You need a deeper system in order to have more stability. Now,
as in money that circulates, right? So you put money in a savings account that gets loaned out to someone who does something else with it. Exactly. Versus you buy gold, it just sits somewhere.
Sits there, right? And interestingly, even with all this, if you look at our capitalization of banks in India, overwhelmingly, they have a massive deposits buffer. This is like totally different from the US or other Western economies, where their capitals come from, different other types of, they give out loans and that's like an entry in the books and stuff. Here, actually, literally, if people have access, they go and put a deposit in. And that actually gives a lot of stability. And despite that, we are not engaging a lot of our users, right? And that's a major, I think, and that's where tech operates across the board, right? It's not about a joint liability group. It's not about, this village somewhere. It's actually for you and me. And also, hopefully, what we are hoping is you and me will get served first in the queue because there is money to be made. What I think I would be interested to see is who is playing to the bottom 3 quintiles, right? And how many fintechs are coming in there or other tech companies. And how are we doing something more than just opening a bank account? Because we talked about this earlier, this idea that, now Indians are predominantly, if you believe the figures, everyone has a bank account. But between usage and access, there's a slip between the cup and the lip, I suppose. We can talk about that if we feel like.
Could you tell us a little about that?
Yeah. So one thing we are seeing is, again, now we have this weird problem where before we were just like access to finance. And suddenly PMJDY came in. And before that, anyway,
this is the Jan
Dhan Yojana.
Yes.
Yeah, Prime Minister's Jan Dhan Yojana. And before that, the RBI, they have a financial inclusion mandate. So they also had done a push. So suddenly you have a situation where everybody has a bank account ostensibly. But if you look at usage, it's about close to half of those bank accounts are not operating, apparently. So no one has done a transaction in the last year, say, or in the last 6 months. So this is very confusing, right? Because that means if you went out in camps and enrolled people, how do you actually get them to use this? And actually, is it built in a way that people can use it? And, the gender angle, one thing that we found in this survey of literature is that women's bank accounts are 2 or 3 times as likely to be one of the dormant accounts than men's.
I would have thought the other way around because...
Sure. But it's a strange one. So now when you have this, then the question becomes like, why are people not using it? So you're back to the situation where it's just not enough to give someone an account. You actually have to make it a value proposition for them to transact with you. And then you need them to trust you. So if you look at some of the technological developments, what we've seen in India is like, I think 2 or 3 big things. And these are the 3 big trends that the Future of Finance Initiative that I work on. One is that you have a lot of new tech companies coming into a traditional market where banks used to be, basically the big dogs of this world. And now suddenly you have, small P2P companies, you have web aggregators, you have a bank bazaar, and they're all coming in and doing things that look and sound like what a bank would do when they are doing an interaction with the consumer, but they're not banks. They're just curating your experience and passing you on to a bank. Credila, student loan company. They don't actually, it's not a Credila loan. It's a back-end tie-up with SBI or Axis. But they reach out to you. They find you. And they find you through a whole bunch of new anchors, right? So before you used to have direct sales agents. This is your person who would come and say, do you want an LIC product? Now it's just a click on Facebook or it's a pop-up. Yeah, exactly. So you have this disintermediation. Simultaneously, you also have like a really large public infrastructure. So this is what, if you're running a private business, I think for banks and in a financial transactions, there are 2 or 3 things you need. You need to identify the person, that they are who they say they are. You need to authenticate the transaction, that it's actually their kind of bank account or not. And then you also need to, at some stage, if you're giving a loan or another product, appraise that person. And so this public infrastructure, its whole, and we can get into that, obviously. That is something we all love chatting about. But the promise for finance was, now you have this publicly built thing. Everybody, you're going to remove some of those obstacles to serving people who don't have documents or too far away, etc., etc. And then the last thing is obviously data. So both of these are connected because now you have user data. So how can you mine this user data? How can you, on the positive side, customize products? So if I'm a farmer who looks after my cattle really well, that means is my livelihood, like my livestock insurance, can I get a smaller premium? That should be available. Is it happening or not? We don't know yet. But that should be, I'm a farmer again and I'm having like a crisis. I should be able to have some kind of flexibility in my repayment because everything is telling me that I'm there. I'm not running away. I've been a good borrower before. There should be no reason to just call that default, right? Like, are we seeing these innovations? But on the negative side, of course, a lot of the stuff I've been working on in the last year is we have the same situation where you have vulnerable people and you have a lot of power over, because data gives you a lot of power. How can we use it in a way that you're not exacerbating that vulnerability and creating some of the things that we've seen in China and Kenya and some other markets?
So here I know that Aadhaar becomes now this can of worms that opens up everything. We talked a little bit about this when we discussed the Aadhaar judgment, Manasa, with you and with Rahul. And so there we sort of saw that what you were mentioning earlier, the cost of giving out a loan is as much as 4,000 rupees or even higher. The idea of doing electronic KYC, maybe based on the Aadhaar infrastructure or elsewhere, could reduce that cost significantly. Right? Similarly, I think Jio, one of the things was the cost of giving out a SIM card was significantly lower than the cost it was even 5 years ago with those forms you fill out in triplicate, and then Airtel has to do data entry, which doesn't. Again, it's not about Airtel, but the idea of telecom companies, having all that paperwork and nonsense that they have to do in order to follow due process. So all that, the idea of a smartphone, the idea of Aadhaar, the idea of access to data, the promise was that the cost of servicing or the cost of providing these financial services could come down. Right? So did that happen at least pre the Aadhaar judgment? Because post the judgment, we don't know what the scene is.
I don't know. This is the interesting thing. I would love to, and this is something that I try and do more, is like actually speak to businesses and ask that question. Because what I would like to see is, has there been a reduction in cost or for the user? I mean, it's great if there's an increase in efficiencies and profit for companies, and that's great. But I love my job for this reason. My primary stakeholder is the user, is the consumer. So then what I'm trying to understand is actually, has this been passed on? Has this surplus been passed on or not? First of all, was there a surplus? And second of all, has it been passed on? And you can measure this in different ways. You could just do like an interest rate, have interest rates fallen in the last X number of years for Aadhaar authenticated loans or Aadhaar based, loans. I don't know how you would track eKYC, because eKYC is just reducing the costs of KYC for a bank as a whole.
Right.
And then I don't know if you can track it by loan, but maybe there are some ways to do that. I think the other question is, I'll say, like, are there new features in these things? Are people somehow making their offering better because you have access to all this infrastructure? And to be honest, I haven't seen much. I haven't seen things one way or another. I've just heard a lot of claims that it's helped things. I do know that a lot of fintech businesses would not have existed today if this infrastructure hadn't been there.
So this is Aadhaar plus India Stack.
Exactly. So there are people who built their business around that.
So I have a question, touching upon several things that you spoke about. So the great thing about technology is that there is a certain stickiness to it, which means that I go back to my app very easily. So the transaction cost actually reduces for me to go out and find out about a new way of investing or find out about how I can save my money better. The transaction cost of me doing that reduces with technology because now it's just a Google search away. Applying that, you were mentioning that the cost to the user has also reduced because of reliance on electronic products.
That's the thing. That is the kind of hypothesis, but I'm not sure that the hypothesis is that you don't need to, take that 5-kilometer walk to the bank.
Correct.
You know.
I'm also sort of talking only hypothetically. We'd love for it to be a reality, but one doesn't know. Yeah. So since on the one hand, the transaction cost should reduce ideally, and therefore it should increase the level of trust that a user has in his electronic system, and therefore build a certain predictability in the user's mind with this system. Do you think that is the kind of sea of change technology will bring?
Yeah, I mean, this is the interesting thing. I think we are very early stages of this journey, but we're not as early as we were 7 years ago or 10 years ago. So we've got some early signs of what's working and what's not working. And I think what's interesting is definitely a lot of companies may not have existed if not for this public infrastructure. So that's great. Already you have one data point to say people are doing something in response to this, the lowered barrier of entry, right? So at a competitive landscape level, it's not just your 60 banks anymore. It's these new people coming in, applying for fintech licenses, trying to target. We wish more would target this market, but there are people who target across the board. But the other thing then is, what are the related costs for consumers and for the market? I don't think that has ever been studied, because a lot of these are not like really easily priceable costs. And I mean, I think there's a one background feature here. So something that's come into my mind is, the ITU, the International Telecommunications Union, they do this kind of ICT access, IDD, I think it's called, ranking, right? They just say ICT access ranking for all countries. And if I remember right, India is like 138 or something on the list in terms of access to technology. So I think, hypothetically, these things all stack up really well, and it's a really nice puzzle. And it's like, we have a mobile phone and we have electricity, we have Aadhaar, we have this, and boom, our powers combined. It's Captain, finance. But like on the ground, we've had so many internet shutdowns. Call drops are at an all-time high. Like even Try is worried about it. So that's always a good sign. So it feels like we have this hypothetical model that works well, but there are so many implementational major significant concerns that we should be okay to talk about. I think what I find and what I think is difficult for us to navigate is, because we so want this hypothesis to work, often raising concerns around implementational issues we're facing can be seen as a challenge to the entire project or the entire, which is fine. I mean, you know what, like we should have challenge to the entire project as well. And that's obviously the reason why we had a Supreme Court judgment on this. There are some serious concerns as a lawyer that I myself do have in terms of how the jurisprudence for this project has panned out. Leaving that to one side, if we look at all of the promise of the technology, I think we need to address some of these things. Like actually, our broadband speeds, our transaction costs. The fact that actually another number I think is useful is teledensity. So the number of mobile phone subscriptions to a person is like 58 or something in rural India, and it's 158 in urban India. So, and people predominantly smartphone penetration, we always like, they'll catch up in 5 years, everyone will have a smartphone. But actually, right now we don't even have a number. I've heard some kind of BCG type reports say 350 million smartphones, or people will just throw these numbers around, but that's still like, you have 1 billion subscriptions and only less than half of those on a smartphone, and you're moving to a digital public and private service delivery model. It's a very big marginal cost, like we need to be thinking, because this is like public policy. This is not startup exit world, and I think now I like the fact that the hype cycle is a bit broken, and we don't have to, we are starting to see, unfortunately, through a very human cost, that if you don't price these kinds of costs in, you come up with a fantastic number for return on investment. But I don't know how indicative that is of things on the ground.
So one takeaway from what you just said was that while we have seen this increase in technology, notional penetration of smartphones, communication tech, all of this into our society, we have some fundamental layers that are still broken, right? Starting from the bare telecom network, the electricity network. Yeah. We still don't, how will you have smartphones if you don't have at least 18 hours a day or 20 hours a day of electricity, and the cost to have an inverter or a backup or something. How do you do electronic authentication when you don't have all of that? So to me, the telecom and electricity seem to be these two key basic layers of technology that don't exist. While we are pursuing 4G and 5G and 6G and all of that. Right? So that's one takeaway. The other, I found it very interesting that there is no conclusive evidence either way to see whether a consumer is benefited, whether the loan rates have come down. The other question I had there was the promise of consumer welfare. So the idea is here, it's not that the loan price has come down or the access to credit cost is lower, but there is more access to credit that didn't exist in the first place, right? So there is like an opportunity cost that we have to calculate. So for example, if I can take an anecdote, I have a old friend who runs one of these small companies which was trying to put out loans. And the idea was that if you're an urban salaried person, sort of from the second or third quintile in India, you might have one bank account. And if that bank does not give you a loan, you don't have any other formal access to credit. Right? So the idea is, and that could be for a wedding in the family, it could be for a whole bunch of things. And the idea is, can someone, if you access their smartphone data and have a sense of their behavior and how they operate, how responsible they are, can you finance that loan? I think that was the premise. And over here, sometimes I feel like the privacy concern dominates over many other concerns because, again, the anecdotes and the stories, I'm sure you've heard many of them too, is, look, I want this loan. You read my messages if you want, but I want my loan. I don't have access to it. So the value over privacy for many might be not very high and might be tradable for greater access to credit. So I don't know what you've seen. If you could tell us about what you've seen anecdotally or more about attitudes towards giving more data. And being able to receive loans for things or access to credit, but did not exist in the first place.
And I think this is one of those interesting things that even on principles, it's easy to work through. So obviously not having information in terms of large studies and stuff is a barrier. But actually the privacy question is a really interesting one because just on first principles, whether that's legal or economic, it's very easy to think about this and agree whether it's right or wrong, So on the economic side, since you might be interested, this whole Alessandro Chisti is this professor who still works in this, and he's done a whole bunch of both, like kind of models and thought about this theoretically, but also actually run some experiments. And you do see that, first of all, there is a kind of salience of the thing that people are trying to access. And if you ask them for stuff while dangling the carrot of this thing, whatever that is, whether that's free stuff or XYZ or a loan, the thing is people are focused on this, right? On the carrot that you're dangling. It's not that they don't care about what you ask them for, especially if you're vulnerable and especially if you're really at a liquidity constraint and you need this thing, otherwise the wedding's not going through or whatever. Likely chances are you're going to agree to whatever it is. So in trade terms, I don't know how economics thinks of it, but as a lawyer there, what I would be thinking about is about the sanctity of this contract and about the kind of contractual capacity, whether it was actually a free contract, whether people are entering to this freely, consensus ad idem, with meeting of minds, and they're not under any pressure in this contract. And I would be hard pressed to think that that's a fair trade, So because there is so much conditionality, right? If there isn't essentially if you're at the point where you're really, and this does increase for more vulnerable people. So I think the idea that it's tradable is something that is fast being set aside in the privacy literature. So we all start off with this property construct of privacy or personal information. And currently the world that operates right now, if you look around, is this idea that you click I agree, you entered into a contract, you have given your privacy in order for services. At least from a supply side, from a Google perspective, that's how they rationalize free services, right? This is the provider model of what's going on. And that's why they don't feel so bad about consumers whinging about privacy. They're like, yes, I gave you all this free stuff. Give me
you clicked, I agree.
Yeah. But I think, interestingly, if you take a kind of third-party look at this, it's not that people are even thinking about the fact that they're giving their thing in exchange for a free service. It's kind of like somebody's giving me free stuff and I took it and they asked me some questions. Those things don't seem to be connected. And one place where I saw this play out, and you've definitely, I think, Manasa, you might have heard about this privacy on the line study that we did in 2017. It's just like we just spoke to about 48, 50 people, but we kind of chose profiles through this human-centered design method. We kind of chose profiles of people that we care about, interested in Tamil Nadu or Uttarakhand and Maharashtra. And we just went through like 2-3 hour detailed, qualitative kind of game-based conversations with them, right? Like, what kind of information do you give for a loan? If you don't ask them, do you care about privacy? But you're like, yeah, they're like, oh, I give my ration card, my Aadhaar card, my phone number, my first child, haha. But like, and then you're like, okay, which one of these do you want to share? Do you not want to share? And then they kind of sort that out. And then it's interesting because I think the light bulb for me was certain people, I said, how do you feel, do you think that this information anybody else should look at? Do you think they look at it? They were like, what? No, I mean, yeah, we gave it to get the SIM card and then it just disappeared. So this idea that the information is being stored is not something that's in the mental model of some people, it seems like, in our country. So we are working on, would love to do a survey on this, a larger scale survey. And I'm sure there are other people now planning surveys around this so that we get more and more data. But right now, it's hard to ask the question properly. So we did this to understand how do you ask the question in a regional language, right? In a way that's not like as less biased as possible. But the funny thing is, I don't think that tradability is in the consumer mind. And I think what people care about, one part of it is economic interests. But actually, because data is something that just grows and changes with you, it's a non-economic interest you're trying to protect, because if someone misuses my data or uses misrepresentative data, like basically my income bracket 5 years ago, which is actually much better than my income bracket now, but life doesn't work well for some people. But like, if they use that to make an assessment about me, that's actually bad for the company and for me, So I think the difficulty with the data conversation in a lot of kind of economic paradigms is it's a non-economic interest, which comes back to how do you price a non-economic impact? Should you? Environmental law is trying to do that to varying degrees of success. Or do you just come in with a normative position with certain guardrails that we just agree as a society, we're not doing this. Like, we agreed with Article 14 that we're not discriminating against X, Y, and Z, right? And actually, I have repeatedly been asked, I don't want to make economics people the bad guys here, but I've repeatedly been asked, like, why is this kind of discrimination bad? Discrimination is also, and not all discrimination, but I think like this whole idea of price discrimination, very gray area. It's actually a good thing. But why does the city of New York have a price discrimination law for Uber? Like, that's as capitalist as it gets. And so I think part of this is when you're talking about non-economic interests, and that's where I think the Supreme Court first Puttaswamy 1 judgment is useful, because they just took a stand and they were like, look, in our constitutional scheme, we're not trading privacy. So this is the outcomes based on how much you're valuable versus you're valuable doesn't work in our country. At least in paper, if we don't start thinking about that, I think it's hard.
And I loved how you presented this, and I think it's a great compliment to some of the conversations we've had on the podcast before,
Absolutely.
right?
I know I was supposed to come in with questions and comments, but just sitting here mentally taking notes, absorbing all this information, Malavika. It's excellent.
But in a sense, your attempt with Rahul and your work on the data protection was to say that, so one of the ways to do this is to come in and say that, yes, while you have privacy, and yes, while some of that privacy might be tradable, we will put guardrails. There'll be some rights that come in that go beyond consent, right? So just by clicking I agree to a set of terms and conditions does not mean people can run away with your private information. And perhaps that is even more critical in a case like finance, where stakes are higher. You are probably more willing to, at the moment, give things away.
Yeah.
But probably you shouldn't.
Correct. And if anything, what Malavika said earlier is very relevant, because it's easy to think through this on first principles, as one should. And if anything, fiduciary duties in financial context are elevated.
Yeah.
So the way we have begun thinking through privacy as non-tradable sort of right in our law is a good step forward.
Exactly. And it's so strange for me that these two different worlds are intersecting because for the longest time, Dvara, like the first ever piece of work I did with them was about suitability. And I did a case law review of how financial cases are working in India and how basically caveat emptor doesn't work. You have to do some level of, only the provider knows how their product works, right? Yeah. And we're trying for several years now, we've been trying to move the dial on suitability. We got like a charter of consumer rights with the right to suitability passed by the RBI. I don't know what that actually means on the ground, but it's amazing that the data conversation has basically just skipped there. And I think, credit to Sri Krishna committee and Justice Sri Krishna, whom I'm a big fan of myself. There are many things that you've seen our response probably. We do think that the bill falls short on consumer protection in various ways. But I think at least, again, even at a notional level, just introducing that vocabulary is a big jump.
Absolutely.
Right?
That you're a data principal.
Yeah. And they are a data fiduciary. So then you're automatically saying they have to ask, act in your best interests.
It just shifts something in our minds as well. We're so used to seeing the words data controller, data collector, data processor. Suddenly you're seeing data fiduciary and you're like, yes.
Yeah. Actually, it's a clever one. Yeah.
And to me, even if I'm not an economist by any stretch of imagination, but if I put on an economics hat, the fundamental problem in this transaction is a principal and agent problem, right? And information asymmetry. And markets do not work well where information is extremely asymmetric. So in a sense, this whole technology thing, you are giving out this loan to someone, and loan being one financial instrument, again, it should not dominate the conversation. You're giving this loan out to someone and you don't know how capable that person or that entity is of repaying this. And so you have to factor that into your cost. So there is an information asymmetry even there. And at the same time, on the other side, this new entity which is giving you this money, and this credit, is asking you for things and might do things with your information that you don't know about. And so if we want that market to work well, we'll need various systems in place, the various checks and balances to make that market work well.
Exactly what you're saying. So basically, the whole idea of technology is how can we, one of the costs is information asymmetry, right? Now currently we're looking at this idea of alternative credit scoring. Credit scores idea is to overcome that information asymmetry, but many people in our country don't have one. So, but the danger is
in India, we don't even know that we need one or need to build one. Right? For example, for the longest time, I had a debit card, and my credit card was there was an add-on card that my parents had.
Amazing, right? So lucky.
Yes, but no, actually, that means that I was not building out my
really?
credit.
It doesn't go from an add-on. I did not know this.
No, so you need to have your own. So I didn't want a credit card, but this, even there the incentives are so messed up, right? You need to have a credit card and you need to show a history that you've, used a credit card and paid back month on month dutifully. And then you're more eligible for a loan. So it's buy our stuff now so that we can sell you more stuff later. So the whole system's messy.
Hashtag consumerism.
Hey, and I bat for markets and
No, it's interesting because the problem is therefore, technology can correct that information asymmetry. But I think one of our major concerns is, what if we overcorrect? And then you've corrected the information asymmetry, but now the consumer is the one with the massive information asymmetry and the liability because they're at the loan. And you have no idea how kind of naked you are to these companies. They can literally, there's a really interesting collection company, financial collection company that you should look up. They're public. So True Accord is what they're called. And they're very interesting. I think True Accord or something. Maybe I'm misquoting, but I think it's True Accord. And they basically use all kinds of data analytics and psychometrics to remind people and to track people down and ask them for their money, right? And to kind of figure out if they are paying other bills and then approach them, which to me is
stalkerish.
Yes, And it's interesting because I think it also ties to one other thing, just to touch on that when you were talking. Fiduciary principle is actually really good. When you have that fiduciary principle relationship, because in this situation they're also thinking, but hang on, is it Is it in that person's best interest that I know all about, what they bought their mother online or something? That's one thing. But I do think there's two things operating here, two concepts, which I've actually only recently been debating with a couple of people. So I'm curious to put it out on the podcast. You do have contractual management of personal data, and I think that's very important. But actually, we have to somewhere still agree, Supreme Court judgment and everything we've talked around privacy is that you have an inalienable right to privacy, and that's not contractual. That's a non-economic, inalienable interest that you have. And actually, all your contractual management has to somewhere can't overstep the lines of this inalienable interest. So that's really that's the kind of the dashboard for management. But fundamentally, it can't be this whole idea that your privacy can therefore be divested. I don't think holds good. So I think we're at the start of seeing in India is two forms of development. One is like privacy, one set of kind of thinking around privacy develop, which is non-economic, an inalienable human right, really. And then you have data protection, which is almost like a contractual management of personal information. And these two things are related, but they're actually distinct concepts. And I think that's the hard thing, even with this bill.
Yeah.
They talk about protecting a right to privacy, but there's no right to privacy in the bill. They talk about data protection. It's all, I think that's something we're all trying to work through.
And in all of this, there are new apps, the new companies, the new technologies that are building new things, offering new products and solutions, some of them being financial, some not.
Yeah.
And the instinctive Indian reaction has often been ban.
Yeah, and that's a danger, right?
And and when we don't ban, the second Indian instinct seems to be regulatory uncertainty. Yeah. Just throw so much hoo-ha out there that everybody is wary of investing, and you have adverse selection, and the skeeviest of people start operating in this space because they know how to get a return, right? So honest companies which are well-meaning or honest, venture capital money does not necessarily enter certain ecosystems because it's way too murky.
I don't know. Right? I mean, it's interesting. I mean, it's just, kind of take it up a level. I just had this random thought, and it's not academic at all in any way. But, I did this fellowship over the summer, and we had like 8 of us, and we did like presentations at the end of it. And they're all from different financial services sectors, right? And the one thing that kept coming back to me is like almost there's the story of overregulation or a particular type of regulation that kept coming through, whether it was microfinance, insurance, this, that, and the other. And I was like, my God, like, is this really a story of like basically how our political economy plays out? Like, what does the state and what does the private sector really want? And this is like this big dance that they're always involved with. And to be honest, there isn't really a consumer lever here. Like, it's nice to talk about it, but fundamentally, it seems to me to be like the dance between control and this kind of like Faustian bargain that the state and private sector has, where the state will allow you to grow, but not that much. And then they'll come in and they'll do something really wacky. So then you have to, private sector, you have to use some kind of weird, again, subversive way to overcome that control. And then the whole thing, I just feel like the incentive, it's just totally like...
No, I mean, we see this everywhere, right? Yeah. Like, for example, my favorite example is how Uber and Ola started a lot of their cab services. Each cab was registered under the All India Tourist Permit because that was this loophole where you did not have price caps. Yeah. And it was a very necessary loophole because urban transport is over-regulated in India and has ancient laws, right? I mean, Motor Vehicles Act. I remember seeing the statement of the 1983 or 84 Motor Vehicles Act. It was to modernize the law because of changing modern times. Because before that, the Motor Vehicles Act was from the 1948 or something. But under this law, there's this loophole that people come in, and then various governments decide, okay, these cab aggregators don't exist or we'll ban them. Or if we do, we will regulate them the way we regulate auto rickshaws. And, we'll put a price cap, we'll put a meter, have these sort of dinosaur-like solutions. And then there is a counter. And that's this weird tumble that we happen to see in technology and policy, right?
That's a good point, but I want to sort of rewind a little bit to what you said earlier about privacy and data protection and us all being confused about their scope. I think I mentioned this at one of the discussions we had at the post the Carnegie Tech Summit, which is we're hardly regulating data protection for its own sake. We're regulating it for the sake of a few other things. We're regulating it so that the larger ideal of privacy is preserved with a step in that direction. We're regulating it so that Ubers and Olas can exist. We're regulating it so that emerging technologies have a comfortable place to be born in and be nurtured in. And I think that, yes, privacy and data protection are not quite the same thing, but they're also not things that can be separated from one another. It's like saying, I'm not religious, but I'm spiritual. After a point, it's just muddled into a single thing. And it doesn't stop there. It has very fast sort of ways in which it manifests in network effects also. I know what you were saying about the consumer being the least, the person with the stakeholder with the least leverage in this dance in the political economy. But I think that's where network effects step in to give the consumer a little bit of a ladder to stand on. And in order to have great network effects, the private entities that collect my data and the regulator that should also probably understand how the tango works.
And actually what both of you said sparked two thoughts, right? One is this whole idea of at a market level, how is this all working? The competitive dynamics of big data and the what is that doing to our world today? And interestingly, every field seems to be talking about this. Like the competition regulator in the EU and our current competition law is being rewritten, and they have a subcommittee on big data and how is it affecting that competitive landscape. And at the Jackson Hole Central Bankers Conference, the main paper this year was about actually how competition in big tech companies are actually affecting wage growth and therefore recessionary kind of pressures. That there's something about the market power that these kind of entities and this accumulates that just totally throws everything out of whack. So I think as a global society, we're dealing with that. And the thing is, it's changing very fast, which is coming to your point where there are all these new technologies and then we'll come up with put a meter on it, I think
put a button on
it.
Red color button that you can push.
Which, by the way, even Amazon is doing. Didn't they have that little button or something, I don't know, where you can reorder something? But I think that for me ties into a larger conversation again about principles-based regulation versus rule-based regulation. And we just love being prescriptive. I mean, I think we're a very command and control country where we can't say, the objective here is to do X, meet the objective. This is kind of like an exam paper that you would have. You would be like, how do you think we should solve this problem? And then you look at various solutions. We'll be like, answer how much is X plus Y, and I think this really prescriptive regulation is just not suited, especially for technology regulation, but every kind of regulation, because you have to be technology neutral. We're building something for the 100, 200-year horizon in terms of regulation. So I think...
But that's the problem, right? Governments not only give rules rather than principles. So for example, again, the easier example is cab regulation. You can prescribe the principle that within 3 seconds, a consumer needs to be able to hit an emergency response mechanism. Okay. That's fair. And then you leave the apps to figure out multiple ways to get there. And then hold them to account on it. Rather than say, install this big physical red button that somebody can press saying alarm. Right? Same thing in the financial world, right? So you can have rules versus prescriptions. The other is the government picking winners and losers. So here, to me, in the payment scenario, what I want to mention is there was this whole payment bank and e-wallet stuff that happened, right? After RBI regulations saying, hey, it's too unsafe to expose your credit card or debit card. So we'll create this new thing. And then the wallets developed and then they're becoming payment banks. In parallel, there is this UPI form of payments that came in. And even within UPI, there is Bheem, which was one app on the UPI ecosystem, which the government was picking over others. Right? So this is we need to wake up from, so one problem is the rules problem, and the second problem is this, I will run a PSU instinct that the government has, right?
Definitely.
And Bheem should not be in a PSU.
It's so interesting. So I definitely agree. I mean, one thing is I don't think it's always a problem. It's great to have a multiplicity of new ways that people can access finance. And I think that's a good thing. So I think the fact that the RBI came out and gave a payments bank license or thought about, championed prepaid instruments. It basically gave people new ways or companies who are not banks to get into the business of banking or finance, right? Or at least functionally providing payments, which is good because banks are not like, we don't have to talk about the papers right now. Banks are clearly struggling in India. So that I think is good. I do agree with the second point though, that this, I think the elephant in the room, and maybe that's an entire podcast, is basically government engagement in every sector. And I mean, the simple point of pricing, pricing of transaction costs, pricing of UPI. This is something that, I've been talking about to a few people over the last few days. And it's the way we've done it in India is suboptimal for many, many companies and for many consumers. And I think, but that's a really difficult conversation to have. I think part of the problem is it's much easier to do the low-hanging fruit, because when you're talking about government over-engagement in a particular sector, like who do you have that conversation with? I don't know, maybe with your audience.
Malavika, thank you so much for coming on the Pragati Podcast. I think we had a wonderful conversation, starting from thinking about finance and microfinance all the way to how to think about government regulation in the private sector. And thank you for that. Thank you, Manasa.
Thank you so much for having me. Thank you.
What did you think of the show? Follow the Pragati Podcast at Think Pragati on Twitter and Facebook, and write to me at podcast@thinkpragati.com if you have any questions, comments, or suggestions. The Pragati Podcast is available on the IVM website, the IVM Podcast app, and wherever you get your podcasts from. We are there everywhere.
Do you wish you were smarter? Well, so do we. But the next best thing?
We could make you sound smarter.
And to help you with this endeavor, we are Simplified, a podcast that attempts to break down the complex world around you with a little knowledge, a lot of poor jokes, and a ton of random trivia.
Episodes out every Monday
on the IVM Podcast app or wherever you get your podcasts.
See ya!
Hello, everybody. We have a brand new daily podcast we're working on with Bloomberg Quint. All you need to know provides the top news on business, markets, and the economy so that you can stay ahead of the curve. Tune in every morning on BloombergQuint.com, the IVM Podcast app, or wherever you get your podcasts from.